Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios here today. Coming up on the end of January, a pretty cool start to 2025. We got all kinds of topics to talk about here today as we're going to be bouncing around between tariffs, historical data, natural disasters, Fed meeting coming up, and all the executive orders that have been, kind of ripped through here over the last couple of days, specifically regarding cryptocurrency, which is by far and away taking away the headlines here on most financial news outlets. So a jam-packed show, all kinds of stuff to talk about today, and we're pretty damn excited about it. As I know that you had some plans of going out west and all that sort of stuff, I'm glad that you're in Nashville, safe and sound. But anything on top of your mind here today, man, about 2025, other than the fact that you avoided the one of the biggest natural disasters in the history of this country?
Yeah, I'm definitely grateful for not being out there and being out of harm's way. I got a lot of friends out in Los Angeles who,
Mhm.
thankfully all of them are making do with what they can, or completely safe. So the audience might know this, but I have the good fortune to kind of attract myself to natural disasters. I was also in Hurricane Katrina in southeast Louisiana.
Yeah, this is
And,
a grad student though, right? At
yeah,
that
yeah,
time?
I
Yeah.
moved to go to LSU to get my master's degree. 2 weeks later, bam.
Well,
So,
as next time you move, you might want to let Al Roker know. That way, they can just let the whole world know that there could be a potential natural disaster, like probability increase here with Ezra moving out to another state.
yeah, right? I mean, at this point, I'm just looking on picking a trailer park in North Georgia just away from everybody because I feel like maybe, that's the only safe spot for me to be. But,
Yeah,
no, I
yeah.
appreciate you asking and the concern. Obviously, I'm safe. I'm in Nashville at the moment, and, thankfully, everyone that I care about in Los Angeles is either in a safe spot or is not affected by the fires. So,
Definitely praying for all those out there.
100%.
All the people affected, feel terrible for them. All the firefighters, all the people there that are they're trying to help out from other states. Definitely, God bless you guys, and keep doing what you're doing. I'm sure things will get better here. Looks like we might get some rain out that way in the not too distant future, which would be welcome. And welcome to the show. The Financial Shepherd podcast. We've been doing this for 3.5 years. 400 something videos, I think, up on YouTube right now, somewhere in that ballpark.
If you
And
count the shorts, I think we're pushing 1,000.
well,
We
yeah, I
do.
mean,
Yeah.
yeah. So it's got 1,000 videos. I
Let's do it.
shortchanged our own program here. The reason why we do that is, I'm not trying to be the next Joe Rogan. That'd be great if, Joe Rogan wants to have me on the show or vice versa, or if, millions of people all of a sudden want to listen to this, that'd be great. That's not why we do this, though. The reason why we do this is because we live in a digital age, which I'm certainly thankful for. I'm sure most of you are as well. We can get information very, very quickly. And it all comes right to these little smartphones of ours that we carry around. And all that technology is fantastic. The convenience is stellar, but it does provide us access to a bunch of information very, very quickly. The news does a great job of bringing things to your attention that you might be concerned about or care about, or maybe want to be fearful of or excited about. One of those emotions will come into play with whatever headline it is that they have. And the reason for all that is because the news is for profit. They like to make a profit, and the best way that they can do that is get their audience engaged. And what the news understands is that human beings, all of us as market participants, are also humans, by the way. Human beings, we feel losses twice as much as we feel good about making a gain. We are risk averse by nature, which is generally speaking the reason why you see news headlines that are placating to that emotion, fear in most instances. And that's not a bad thing, bringing things to your attention. However, what the news does a very bad job of, in our view, is they do not do a good job of providing you with historical precedent relating to
Mhm.
things like the market. And that's what we try to deliver here at Shepherd Wealth Management, not just on this program, but for our actual customers. This is a huge, huge advantage for our customers regarding their performance. I've done quarterly reviews for damn near everybody. We have over 100 households that we serve across 15 different states in the United States. We can work with anybody in the United States, and everybody after this political election and everything that's just kind of come around here over the last couple months. People are all over the place with their emotions. And we do a great job of providing an edge for our customers and looking at the market through this historical lens. And what we've found after doing all these quarterly reviews, all of our clients that have been with us for 3 years or longer, we've been in business for 3.5 years. Everyone that's been there for 3 years or longer with us, which included 2022, which was one of the worst stock market years since 2008, was the worst stock market year since 2008, included that terrible year in there. So everybody that's been with us 3 years or longer has at least tripled the market's performance. And it's not because I'm sort of Warren Buffett Jr., although I do try to strive to do the things that I think he would do under the circumstances that we're dealing with right now. Is because we look at the market through this historical lens, and that provides us with probabilities. It's not a guarantee. Past performance is no guarantee of future results, and investing involves risk, including risk of loss. But it does help us understand very clearly what the risk and reward is for every investment decision that we make on behalf of our customers. And we don't have to have finger, in the wind guesswork here. We can literally say, this has happened, whatever the circumstance is, interest rates are going up, down, new president, whatever it is. There's always been a historical precedent to it. We can look back and say, okay, over the last 75 years, this is what we're concerned about now. And this has actually happened. I can see 12 other times over the course of that 75 years. And here's what the results were for the market in the various sectors that make up the market. Again, all you're doing is looking at those probabilities and putting them in your favor to help you drive your asset allocation to the things that get you the results that you're looking for with the type of risk profile that you're comfortable with. In other words, this is known as modern portfolio theory, which is something that they teach in business school around the world. It's just a simple way of saying, hey, by controlling the mix of stocks, bonds, and cash, otherwise known as asset allocation, that actually explains 94% of the variability of the performance results that an investor would have over any period of time. And why you should care about that is because there's all kinds of stuff that you'll never be able to control as an investor. But the one thing you can control is that asset allocation. And the other thing that you're going to need to control to have sustainable success, according to Warren Buffett, the number one reason individual investors do not achieve the results you're looking for consistently is because they have no control over their temperament or their emotions. Well, what we found here is that by understanding how other human beings have behaved relative to whatever it is that we're dealing with right now in a risk headline news article, you can start to put those probabilities, in your favor and actually get control over your emotions by understanding what the risk and reward is, what the expectations should be, given these circumstances that we're in right now. So that's what this show is all about. So if that's what you're looking for an edge, a different way to go about controlling your emotions and making more informed decisions, you're in the right place here at the Financial Shepherd Podcast. So please like, subscribe, and share. That way you're aware of every time we drop one of these podcasts on YouTube about every 2 weeks. And what I think the biggest takeaway here, Ez, before we get into the content of a particular show, I think you'll enjoy this since you've been with me, editing all these videos for the last 3.5 years, 1,000 of them. To your point, I know that this isn't like, you didn't go to graduate school to do what I do. You're not a financial expert by any means, but you've been around the whole time, and you've heard me, go through these sometimes rants, sometimes just fun conversations that we get to have about markets and things that are going on. But one of the feedbacks I got from a customer yesterday, I was doing a quarterly review, is their first full year at Shepherd Wealth Management, had a great year. And one of the things that she told me or shared with me at the end of this is saying, hey, I hired you because, this isn't my area of expertise. It's very uncomfortable. I get very emotional. It was a tough decision for me to turn over control. In her mind, those are the words that she used. Turn over control of my investments a year ago to allow you to do your thing. And I'm so thankful and happy for that. But I got to tell you, the thing that I love the most about what you're doing is I actually feel like I have more control over my own investments and the outcome of those investments, even though I am not the one making the day to day investing decisions. That was the most beautiful compliment I think I ever could have got, because that is exactly what our strategy and program here, not just for the podcast, but for our clients, is all about. I actually write to them every single week via blog that we push
Yeah.
out to our mobile app. As you already know, we push this podcast out to all of our customers every time we do one every 2 weeks. And we write a newsletter at the beginning of every single month, and we go down and sit with them either on the phone, Zoom meeting, or in person, ideally, every single quarter to ensure that we're getting them the types of results that they're looking for that meet their needs and their risk tolerance. So this has been a blast, man. This is truly a dream come true. Couldn't be more happy and excited for this new year and everything that's going to come along with it. So I thought you might enjoy that as before we jumped into today's content.
I do. That's so great to hear. And yeah, especially somebody like you said who's been around since the beginning. I mean, I remember when we were doing all the local business interviews with
Yeah.
people around when Shepherd Wealth Management was just starting, and like you said, the economic climate at the time. I mean, it was just dreadful. We were barely out of the pandemic, and everything was recoiling and trying to speculate on how to rebuild from that. But I know I've been nothing but impressed with the things that we've said on the podcast and your ability to kind of apply historical data and at least approach what to do when the next crisis hits the news with a calm mind. And like you said, the performance here speaks for itself, and that's been the thing that's the most impressive to me, just seeing how you've been able to navigate hopefully the worst time we've had in a while.
No, no doubt.
If we don't go another just 10 years, then it's like, oh hey, this is now the worst.
Well, there's always going to be something, right? And then we have to be prepared at all times to adjust, to pivot when needed, and that's what this program is all about. But speaking of disasters like 2022, clearly we highlighted this right at the beginning of the program.
Mm.
Kind of praying for all the people out there in California. A lot has been said about that. What I wanted to bring to everybody's attention, we have a very big week coming up next week. There is a Federal Reserve meeting. I believe it's Wednesday. Give me one second, as I want to share that with the audience exactly what day that is. So Fed Chair Powell has a press conference meeting. Yeah, that's right. Wednesday, January 29th. It'll start at 2:30. We'll get the rate decision at 2 o'clock. Nobody's expecting the Federal Reserve to cut interest rates, unfortunately. We'll have to see what that looks like in March, which would be their next meeting after the meeting coming up next week. But on top of that, we also get GDP, we get jobless claims, and then on that Friday of next week, the last day of January, we're also going to get a whole bunch of inflation data, which is kind of unfortunate. I would love to see this inflation data come out before a Fed meeting, but that's just not the way that this one's going down. So again, I'm not expecting any rate cut decision, coming up next week, but we do have a whole lot of important, jobs data and inflation data. And what I wanted to bring to everybody's attention, and the reason why we're doing this, as you remember this very clearly, last year there was a hurricane in Texas, if I'm not mistaken.
Yes.
The Bureau of Labor Statistics, the BLS, decided that the 2 million Texans that were without power for about 2 weeks, that included businesses, of course. The Bureau of Labor Statistics at that time said that that particular natural disaster was not impactful. They did not adjust their employment data that particular month, and it freaked the market the hell out. And the Fed didn't do anybody any favors when that happened either. They could have just plainly said, "Hey, the bureau got that wrong, and this was in fact impactful to a couple million Texans when that took place." Now, obviously, these wildfires, the disaster that happened in the Carolinas as well. Obviously, Florida had some impact there. That was several months ago now at this point. But all of these things do have impacts on things like GDP. It does impact the jobs data, and it could have some sort of impact on inflation. Although I think that that's really not too much of a concern here. It's really about the jobs data. Those numbers certainly could be distorted, much like they were when the hurricane happened in Texas last year. So that's really what I wanted to bring to everybody's attention there, other than, anything that you can do to help out with anybody out in California in the situation that they're dealing with there. Whether it's a thought, prayer, a phone call to anybody that you know out there with some encouraging words, or just donations to places that are trying to support those out there. Please feel free to take that initiative and help a fellow American, fellow human being out in their time of need. Anything you want to add to that, Ez? I mean, I thought that was pretty much the only impact that may come up next week as we get some of this, fresh jobs data, inflation data, and the Fed's take on not only the new administration and some of the executive orders, but also The natural disasters that are certainly going to have some sort of economic impact, even if it's just, hey, a whole bunch of taxpayers are going to have to cover $500 billion between everything that's happened in all these states, recently.
Yeah, I mean, I think you're right on. I mean, we should expect it to see it show up in the job numbers, in that data. I mean, last year definitely was a major indicator of that. I mean, we caught a lot of flack on the comments for the videos and the shorts for the show when you were pointing that out to people, that like these job numbers are kind of cooked. You know, you had
Mhm.
2 million people who couldn't work for, some of them, a couple of months maybe,
Right.
and through no fault of their own. It's not like that they wanted their homes to get wrecked by a hurricane and be out of a job. And you're seeing now, certainly not that many in Los Angeles, but tens of thousands of people have had to evacuate, and unless they work from home, they can't work, right? So it's
Right.
only, that's what, I'm not, this, I think everybody would agree, this is what you have unemployment for, is these temporary safety nets, right? So when
For
they're
sure.
filing claims temporarily when they can't work, that's going to show up in the job data. So before we see and start blaming people, for things, we need to start actually understanding where this is kind of coming from. I mean, we've had so many examples of this just in the past 2 years, right? Of how these little micro, um, they're not micro events for the people who are going through them, but in a grand economics, take the whole economic system of the U.S. Like, they're very small little blips, but they cause these kind of distortions that can really make people freak out and have the worst view on it possible. Like you said, they're
No
all,
question.
everybody here's Americans, and nobody wanted the fire to come. Nobody wants a hurricane to come. You got to band together and help people out. And letting that skew your opinion on the numbers, I think, is a really wrong, is just the worst thing to do. So, not the
100%.
worst thing to do,
So,
but as far as what we talk about on this show, it's very bad.
yeah, I agree with that. I mean, it's just something to make everybody aware of. I have no idea, if the Bureau of Labor Statistics is going to call it out accurately this time. I would certainly hope so, given that, Los Angeles is like the fifth largest economy on the planet.
Yeah,
10%, I think, is what we talked about before the show here. About 10% of all Americans live in the state of California. So there's, if the Bureau doesn't think this is significant and impactful in the labor data, then I don't know what else would be. But I wanted to get in front of all this before all that data starts to roll out next week. So you heard it here first, folks, that this is probably going to be distorted data because of these natural disasters. Obviously, based on everything that Ezra and I just talked about, it should be a no brainer, but there's very likely going to be a whole bunch of headlines saying, oh God, the jobs market, it could happen, but they're not actually going to talk about the impact of all these natural disasters having on that data, right? And that's what freaked everybody out with that um, BS that the Bureau of Labor Statistics gave everybody with that natural disaster in Texas last year. And again, the Fed didn't do anybody any favors because the concern at the time is that the Fed waited too long to start cutting rates. Therefore, they're now going to destroy the jobs market. That was the news
right,
at that time, which was a bunch of BS. It is unnecessarily causing anxiety and volatility for investors and therefore the market reason whatsoever. And that was my gripe with the Fed meeting late December and getting off that data dependency stance and trying to force the committee members essentially to project out what they think this new administration's policies will be, how they'll be implemented, and therefore how they'll impact things like jobs, the economy, and inflation. That would be like trying to solve a very complex calculus problem with only one piece of data. You can't even come close to an answer, let alone an accurate assessment of the situation. So I actually do believe that the Fed's going to end up cutting interest rates more than they think this year. And I'm going to make a case for that um, here in just a second. But before we do, one of the things that I wanted to also talk about is tariffs, since there's a tie in here. And Ez, don't let me forget to come back to the part that we're kind of leaving off here, if you can. But the tariffs piece is been a very big question from clients as I go through these quarterly reviews, and we're getting close to wrapping those up here at the end of this month. Probably have them wrapped up by the end of next week for the most part. But a lot of clients are wondering, much like the news continues to talk about, is what might be the impact of implementing tariffs on things like inflation or the jobs market. And here's what I have to say about that. And I think this is maybe the most simple way that I can help somebody understand that this truly should be a data dependent answer to this question of tariffs, because we just don't know when they're going to be implemented, how they're going to be implemented, in what sectors, and in what timing. Like I said, the Fed doesn't have any of the answers to that, so it'd be impossible for them to come up with an accurate assessment of the situation. Therefore, I do believe they end up cutting more than they're telling us right now, which is actually a really good tailwind for those that are bullish on the stock market this year, which we certainly are, and we'll share some of our thoughts about that. But here's what I had to say. So about 9 years ago, roughly, whenever the last Trump administration was, right? Since this our we actually have a historical precedent here of tariffs being implemented at that time. So when I was addressing this particular client in this quarterly review, I asked them this. I said, okay, well, before Trump's first administration, where tariffs were implemented, can anybody, without looking at Google or Chat GPT, can anybody name the last administration, the last White House that either mentioned the word tariff, let alone actually implemented any tariff policies? And not surprising to me, nobody could come up with an answer for that. On top of that, so again, decades of administrations, Republican, Democrat, and everything else before his last term. And nobody even hardly mentioned the word tariffs, let alone actually implemented tariffs. So I could understand 9 years ago when tariffs were first brought up and implemented, decades of other administrations not touching it or even talking about it. I could understand how that could cause some anxiety. Learned from that historical precedent about 9 years ago is a couple of things. One, the tariffs were not wide and broad based across every consumer good and product that's ever been made or shipped into this country or out of this country from a tariff perspective. That was not the case. There wasn't any inflation at that time. So you can't make an argument from a historical perspective that that caused any inflation, because it certainly did not. And in addition to that, most, if not all, of those tariffs were kept on by the Biden Harris administration because of the lucrative revenue that it brought in without actually being the driver of inflation. The inflation driver was the COVID shutdown. I mean, if you shut down the whole global economy for more than a year, try to start it up all over again, um, there's certainly going to be some distortions, cause some inflation relative to supply and demand. And in addition to that, I do give a lot of credit for the outgoing administration that just left, in the sense that they were dealing with a global pandemic that we have zero precedent for. And they did a lot of things from a policy standpoint, just everybody from blowing out to anarchy, in my view. Now, you can debate the accurate assessment of that or not. That would certainly be everybody's own opinion, and I appreciate everybody's opinions. But I'm here to provide grace under the stressful circumstances and the decision making that had to happen. But those two factors were really what the driver of inflation was. It had nothing to do with tariffs. Therefore, the announcement by the Fed in late December to try to take into consideration the impact of tariffs on their monetary policy decisions is a bunch of crap. I have no idea why this politically agnostic group of bankers decided to basically their own entity right in the middle of politics. I truly do not understand that in any way, shape, or form. They should be an independent organization. They should be free to make the monetary policy decisions that keep Americans employed, maximum employment, and prices stable. Those are the two mandates. And the crazy part about all that is they were so data dependent for 2 straight years. And as we sat here and did these podcasts for those 2 years, covering the Fed in great detail. And I was against a lot of the data dependency stuff that they kept talking about, because the market's a forward looking mechanism. And the Fed is looking at old, stale data. In other words, being data dependent, letting all that data come in and then making an assessment after studying that information. Now they're saying, hey, we're going to try to project forward. And that freaked the market out for understandable reasons. What I simply would have said is like, hey, 2 years ago, when this was a major issue, we had to increase rates at the fastest clip we've seen since 1980. You guys said that this was impossible to go from a 9% inflation problem back down towards 2%. But guess what? We did it, and we did it with a data dependency model. I don't see any reason why we need to change that going into the next year. We'll let this administration do their thing. They have the right to do their thing, given what the American public voted on. And we'll take a step back and see how that impacts things like jobs, the economy, and inflation, and we'll go from there. I look forward to taking your questions. And you're welcome, by the way, for getting you guys from 9% back down towards 2, right? That should have been the freaking press meeting. But if we look at history as our guide, as we always have here at Shepherd Wealth Management, those are the actual historical data points. No inflation, and tariffs have actually been a great negotiating ploy and revenue driver for Americans, which is really what I think the point is of all of this. Now, of course, no negotiator, no business person, which is exactly what Trump is going to tell you that they're going to take anything off the table. They want everybody on their toes, wondering, what could happen or how this may impact my business. And really, all we're trying to get accomplished here, when words like tariffs are thrown around, um, really just trying to get what's best for American business and American citizens. And that actually is a historical precedent that we can look back to and say, where was the inflation, right? So I have an issue with the Fed bringing politics into their assessment of things like monetary policy. Now they're going to have a ton of pressure on them because of what the president had to say last night, basically demanding lower interest rates. He's going to get it anyway, because it is in fact the right thing. Because the ironic part after that Fed meeting, as you know, is the Friday after the Fed had their meeting on December 18th, just a couple of days later, their favorite measure of inflation, core PCE, came in at half of what analysts thought. And a couple of weeks later, we get wholesale inflation, PPI, that came in lower than expected. And then we got headline CPI shortly thereafter that here in January, and that also came in on the core lighter than expected. And the question is this sustainable? And why did this actually happen? Now, we wrote, as I told everybody here, a blog, a weekly, usually one page, maybe 2 pages of what happened that week in the markets. Why did things happen that way? More importantly, what does history have to say about it? And how do we take all that information and position our clients accordingly to take advantage of that? Well, one of the reasons why we're so bullish on the fact that the Fed is going to end up cutting more than what they've told us they would likely do in their last December meeting in 2024 has to do with shelter inflation. So the December core CPI came in at 0.22, positive 0.22%, which is the best reading since July of 2024. At that time, July 24, CPI came in at positive 0.17. And this reverses 3 months of rising core CPI readings. And the main reason we are encouraged by the inflation report is that we see this as repeatable and setting up a favorable comparison to a year ago. Now, January, February, and March of 2024, everybody on TV, as you can back me up on this because we were talking about it in January, February, March of last year. You can go back to YouTube and check out all those podcasts. Core CPI readings last year for the first 3 months came in hot, and it had everybody concerned. And the Fed basically went from 6 interest rate cuts priced into the market at the beginning of January last year. And by the time we get to March, it was like 2.5 cuts were priced in, right? It's a ton of volatility. Now, the January 2024 CPI reading was positive 0.39, February positive 0.36, March 2024 positive 0.36. So just comparing the December core CP first 3 months readings of last year, way lower already. But the other reason why we think this is so repeatable is because the shelter component of CPI, that's about 40% of the CPI basket weighting anyway. It's the biggest component by far. Shelter has been cooling sharply. December shelter CPI month over month came in at positive 0.26. In January, February, and March of 2024, the same shelter CPI reading month over month in January, um, where the data point go? All right, it came in January at positive 0.64, February positive 0.42, In March 2024, shelter positive 0.40. And as of last month's reading, positive 0.26. So shelter is falling like a rock in the CPI calculation. And again, it is the biggest weighting. It's about 40% of the overall CPI basket weighting. So, yes, we do see inflation continuing to fall. And if the neutral rate is right around 3%, and we're at about 4.5% on the Fed funds rate right now, and we go through 25 basis point cuts at a time, that would imply the Fed's going to have to cut rates about 6 times to neutral. Neutral just simply means that the Fed has their monetary policy, their interest rate, the Fed funds rate at such a level where it's not restricting the economy from growing, but it's also not stimulating the economy either. It's not a known number that can be calculated with a calculator and a pencil, but it is a guide path that gets the Fed back towards a long-term inflation run rate of 2%. So if they're calling 3% the neutral rate, that would imply about 625 basis point cuts from where we're at today to get down there. So the Fed is, in fact, still restrictive, and they get more and more restrictive the longer that they hold their interest rate policies where they're at as inflation's falling. So there certainly is some major tailwinds here, given all the hand wringing that has happened post that Fed meeting and all the volatility that's taken place. And the way that you would want to visualize that hand wringing is kind of like a spring that gets coiled. Everybody's super frustrated and worried about tariffs and the economy and how it might impact inflation and immigration and jobs market and all this hand wringing that's happening basically since the Fed's meeting in December all the way until I'd say the second week of January. It's just coiling up this spring. And when it gets unloaded, and the unloading part happens when the Fed starts to look around and say, well, damn, we are way more restricted than what we wanted to be. And, they finally implemented all these policies in January and February. And now we're in our March meeting. And I'm having a difficult time of actually finding out where the inflation impact is here with some of the things that they've done these executive orders on. And unemployment doesn't seem to be going up. It's still either low or going lower. Shit, I think we need to cut rates. Makes sense, right? Then you get that spring to unload. Loading is people pouring investing dollars back into things like stocks, risk on type of assets. That, in fact, is really what we've kind of seen here over the last couple of weeks, given the fact that a whole bunch of executive orders have actually been implemented and all the data that seems to come out here, at least recently. Again, it takes time for any policy that's implemented. It takes time. This is the other part of the equation that I had, or discussion I had with in our quarterly reviews, talking about tariffs. I'm like, let's just play devil's advocate here for a second. Let's just assume for 1 second that every policy that this administration is going to implement sucks. Let's just assume that it's going to hurt jobs. Let's assume that it's going to hurt inflation. It's going to hurt all the things that you care about and the news continues to talk about. Let's just assume that that's the case. Well, when they implement those policies, it still takes time, in most cases, months, if not quarters, to have any sort of relevant impact on the economy, jobs, inflation, etc. So I say that to say this: we do have some historical precedents to take into consideration here that we touched on in our last podcast. We've come out of 2 consecutive years in the S&P 500 of back-to-back 20% returns or better. That is very rare. It's happened 5 times since 1881. Okay. In all 5 instances, the first 6 months of the third year, 2025 being the third year now, in all 5 of those historical instances, the first 6 months of that third year was really good. It's just a question of how good was the back 6 months. So keep in mind, if we're playing devil's advocate and we say all the policies that are going to be implemented are going to be brutal for the economy, it's still going to take months or quarters for that actually to show up in economic data points that we can point to and say, yeah, damn, that was an issue here, right? So if you take into consideration that historical precedent I just gave you and the fact that it might actually take a couple quarters to see true impact, you should still feel really good about the first 6 months of this year. and you need to be nimble enough to understand what the back half is going to look like. I'm going to talk about that here in just a second. But I feel great about the first 6 months of this year, regardless of what's going on from a policy perspective. Even though I would just say that if you take in the president at his word when campaigning on I'm going to do deregulation, less taxes, all that, I would actually make an argument that those are big tailwinds for the stock market potentially in the back half of the year, which I'm going to talk about in just a second. But over the first 6 months of this year, should feel great. We're in corporate earnings seasons right now. It is awesome. Earnings have been fantastic. The big banks kicked them off and they were stellar, all of them metric. Which is obviously a very important sector of the markets. About the third largest sector is 12% of the U.S. stock market in the S&P 500. So that was great. As I just already mentioned, all the inflation prints we've received so far have been awesome. The biggest one of which shelter is falling off a cliff. We'll have some Fed speak next week. We'll have multiple different Fed meetings. And by the way, we'll have two full earnings seasons and a whole bunch of jobs data between now and the middle of this year. It happens to be that the Fed meets in May as well, which is really close to the middle of the year. I believe that we'll have everything that we need about the back half of this year, whether it's going to be good or not. Because one of those five instances that I mentioned, um, the third year after back to back years, one of the years was 96, 97. And the back half of that year was actually absolutely awesome. It wasn't quite as good as the first 6 months, but it was damn good. And the overall year was, very similar to what we've seen over the last couple of years out of the S&P 500. So I don't know if the back half of 2025 is going to be something similar to that or not. But I do feel that we'll have the majority of the information that we need sometime right around May when the Fed is going to have a pretty big meeting. Whether or not they cut, we don't know any of that just yet. We got to see what they have to say next week and get all this information, right? But by May, you'll have two earnings seasons. You'll have all this information known. All the Fed speakers, Fed Chair Powell, and everybody else will have said what they want to say. You'll see this administration execute policies throughout their term, but a lot of it's going to happen between now and let's say the end of March and the first quarter of this year. And we'll know all that information. I think we'll be able to make an accurate assessment on what the back half might look like. Is it going to be a 96, 97 sort of back half? Or is it going to be like one of these other four back halves where it doesn't mean the whole year is negative? It just means the back half of this year might not be as much fun as the first 6 months of this year if we're looking at history as a guide to help us understand what this 2025 stock market year performance wise might look like. So, a lot to continue to study here. This is going to be a fun year, I believe, just because there's all kinds of information to look at and make assessments with, and we're going to get to watch people like the Fed chairman and others in this administration, the cabinet, make decisions. What those decisions look like and how it affects things. So the word for 2025 that we're going to probably repeat over and over again is we're going to need to be nimble as individual investors. We need to be nimble to get ready to add to stocks um, when things are prosperous. And certainly the first 6 months of this year is looking pretty damn good. I want to get to crypto here in just a second. But you also need to be nimble enough and humble enough to understand what the historical precedents are and be ready to add to things like fixed income, which is certainly a not a bad place to be, especially in the back half of the year. If there's a lot of volatility and interest rates are still coming down, you can actually make some money in fixed income and protect the hard-earned gains that you've hopefully achieved over the last 2 years with excellent stock market. So, getting to the crypto news to wrap up the show here today, as um, administration has run a campaign a lot. One of those things was pro crypto. And President Trump decided to create a task force yesterday, essentially to roll back some regulations that prevent half of the market effectively from being able to invest in Bitcoin and crypto. So, for example, banks, J.P. Morgan, Goldman Sachs, Bank of America, pick any of them. None of them can invest in any of that. If they hold on to any of those crypto assets based on the way that the prior administration regulations were for that asset class, they had to treat it like a liability, which effectively meant they had to hold more cash reserves to offset that liability according to the prior administration's rules. So a lot of that's being rolled back, or at least looked at to try to roll it back with the new secret or SEC chairman is stepping into office here pretty soon, along with this new administration's cabinet, from a commerce secretary standpoint and everybody else. They're looking at what the regulation should be and how the financial system should be regulating things like cryptocurrencies. And once that is known, that will open up the other half of the market. So the only people that can participate in this right now are retail investors, you and I. Fidelity, I used to work there. They have a Bitcoin ETF, right? That's great. Retail investors can buy it, but Fidelity's army of mutual fund managers, none of them can buy Bitcoin directly, right? So it's opening up the other half of the market by coming up with regulations that are sensible, for this new asset class and for others, Fidelity banks, etc., to regulate it, know what the regulations are, and know how they can use these things to help their clients get access, and make recommendations for individual investors that they serve. So that's a big deal. Once the regulations come out, now it's going to be much easier for states and the federal government to actually hold things like crypto assets as part of their reserves. And that was also part of the announcement yesterday in creating this task force to come up with a regulatory framework that actually makes some sense for this new asset class. uh, After that happens, my assessment of that would be, now that the regulations are known and this administration is asking for a strategic reserve of crypto assets by the Federal Reserve, that's when that actually takes place, in my view. That is my opinion. Nobody really knows what the answer to that actually looks like, or if we'll even get there. It's very possible that they'll go through all this in some way, shape, or form. Maybe half of it gets done, or none of it, or a quarter of it. I don't know. We're all going to have to be nimble enough and humble enough to be ready to make strategic decisions as we go throughout this calendar year. Um, so we'll all be data dependent as it relates to this new asset class that is kind of sweeping not just the United States investor, but global investors. I think that we could have a much bigger conversation as probably about the utility of Bitcoin, and what this actually could mean for a very diverse global economy. And maybe we'll bounce around that just a little bit before we wrap up the show here, if we got some time here. As the way that I view this is, if pick a country that's maybe not as developed as the United States from an economic standpoint. So go to certain places in South America or Africa, or pick a continent or country. I think a lot of individuals would like to be able to exchange with U.S. dollars, goods and services, products, and investing. Problem is, US banks are US banks. So unless you're a very wealthy individual in one of those countries, you're not doing international bank wires and stuff like that. You're going to be using whatever the currency is in your home country, which could have some significant problems in holding its value. So something like crypto with a finite amount of digital currency available, and making it global, since it's tradable 24 hours a day, 7 days a week, 365 days a year, actually has some utility in the sense that people in Africa and other nations exchange with other people across the world very quickly and conveniently without having to go through all the banking entities in which to make that transaction possible. So there is some certainly use cases. I know a lot of people are questioning that, but that is the biggest one to me. As I don't know if you have a different view on that, and the reason why we asked the question and want to kick it around a little bit is I have been, and this is we have video evidence of this. 3.5 years ago, I was one of the most anti-crypto people out there, right alongside Warren Buffett. I didn't fully understand it. Very classically trained from a investment standpoint, believing in modern portfolio theory and value investing and discounted cash flows and all the things that they teach you in school. You bring out this, weird thing years ago, and now we're not only big believers. I'm a big investor in it. We have some clients invested in a um, round for cryptocurrency, taking advantage of the asset class through MicroStrategy. So yeah, that's my view of the upside here and what the use case and utility of Bitcoin would be. I'm just curious if you have a different take on that, because I know that you've been participating in this asset class and you've actually been nimble enough and open minded enough way before I was to try to learn about it, understand it, and you've gotten to a place where you were able to invest in it in a smart way, even before I did. So I probably only picked up this mantle and ran with it about a year ago, give or take a few months. So I'm wondering what your thoughts on this are, as I know we talked a little bit before the show here about some of the stuff.
Yeah, well, first, I just want to say that comparing my investment acumen to anything you do is not even not even the same sport, man. I'm in the kiddie pool, you're doing high dives on the Olympics. All right. So I appreciate the compliments though. But yeah, you're correct. It's been several years since I've been a crypto investor, specifically Bitcoin. There were some other smaller coins that I had some fun with, made some money on, Dot being one of them, Stellaris. But those all had aspects of the blockchain in mind when they were developed. So they weren't necessarily what you would call a meme coin, which is somebody that just say like wants to take it. I want to make my own crypto, and here it is. They were reacting and trying to contribute to the technology. So, um, but I'm only saying that to let our viewers know that really Bitcoin has been the main focus for me, and it's because of its longevity and its proven history. I mean, I can remember I think it was like 2011, there were some kind of websites for like obscure bands I was into, and you could buy their merchandise with with Bitcoin.
Yeah.
You could spend 8 Bitcoin and buy a T-shirt, and
I
that
think
was some.
somebody bought a pizza, right? Way back when it first came out for
Yeah.
like too much Bitcoin. And it was like, oh shit, that's worth like $1 million or something like that.
Well, now, yeah, back then it wasn't, I mean, back then Bitcoin was so cheap. I mean, it was cheaper to set up your computer to mine it yourself than it was to buy it,
Yeah.
that because nobody thought it was going to have any legs. Nobody cared for it. But, your kind of example of someone in a country or just in some sort of economic sphere or monetary sphere that doesn't have access to maybe some of the top currencies in the world, and they'd like to be able to use that. That was what Bitcoin kind of had in mind when it started. Was it was a separate way for anyone to put a monetary value into this currency and trade it completely outside of the current existing markets. So it was like an everybody's money, right?
Yep.
So seeing it now being adopted, I mean, you kind of saw this coming to me, at least I think we talked about this very briefly, like I think it was 2 years ago, maybe.
Yeah.
El Salvador adopted Bitcoin as a national
Yeah.
currency. They had the foresight,
Yeah.
and then of course it tanked, and everybody was like, "Screw you, El Salvador!" And they were like, "Just wait, it's going to rebound," and it did.
Yeah.
So, you kind of see this coming about how when it catches on, the U.S. has to figure out a way to regulate it for itself because they don't want people to not be able to pay taxes on those things, right?
Yep. Yep. And
So it does give people, like you mentioned, a portal into U.S. currency, which is great. Um, but the higher the Bitcoin gets, it doesn't give you more access to any more U.S. currency than you actually have, right? You can't just like flip your money by turning it into Bitcoin and turning it into U.S. dollars. It's still the exact same amount of money you had. It's just however you mark it or count it, whatever currency, the amount of that's going to change.
yeah,
So
and for the investors looking at the upside of this, and this is where I'm coming down on it, why the US wants to consider this strategic reserve idea. The value of that for taxpayers and investors out there, and this is my view of it. Um, you have gold, right? That's no longer backing the US dollar, an asset class that is relatively finite. So it should have a store of value. And under difficult circumstances, higher inflation, bigger concerns, that commodity, due to its finiteness, tends to go up in value, at least during those times of uncertainty and higher inflation. We saw that, of course, with gold hitting all time highs as the Fed had to stave off accelerating inflation, as we've already touched on. Now, if gold is about, I'm going to round it up a little bit. Let's call it $20 trillion, 19 to 20 trillion. Let's just call it 20 trillion. Well, you can take out about 1.5% of new gold from the ground every year. So all the gold that's available out there, about 1.5% roughly can be mined on an annual basis from the ground. So not a complete finite amount, but we're not adding a whole bunch of supply to that either. Every single year. Of course, it takes time for gold to be created, as we already know. In crypto, to your point, Ez, and everybody I think gets this, is there is a finite amount of crypto. And if crypto is Bitcoin specifically about $2 trillion in total value that's out there today, and this is now going to be looked at as a backing of the US dollar, much similar to the way that gold is looked at, even still today by a lot of people. Um, the only thing that can happen for crypto, specifically Bitcoin, to trade in parity with where gold is at, again, you can't get more crypto. There's only so much of it, period. Well, price has to go up. That's the only way that you can make up the parity level between the 20 trillion in gold and the 2 trillion in crypto. And that would imply, roughly speaking, you know, Bitcoin itself would be around a million a coin or so right here today if it was trading in parity with gold. And of course, we know that Bitcoin is trading, at least at this point in time, around 105,000, 106,000, something like that. So roughly a 10x move from here. And that might not even be accurate. It could be much higher than that. It could be a little bit lower than that. But the point is, there's a lot of room between now and there on the upside. And the upside looks so good if this is in fact held or required by Congress for the Federal Reserve to acquire more Bitcoin throughout a number of years, strategically, you know, dollar cost averaging, to your point, as the way that you do it and the way that we've done this with other clients. The Fed is essentially dollar cost averaging and acquiring more of this cryptocurrency. Well, if that actually happens, can you imagine the value that the Federal Reserve will be sitting on? I mean, we're 36, 37 trillion dollars in debt as a country. And if we held a couple million coins, we've already seized about a million coins anyway, about $21 billion worth of crypto assets with all the stuff that happened last year with Sam Bankman Fried and all the other fiascos with some of those shady actors
Yeah.
early on in crypto days with their nefarious ideas about how to take advantage of uneducated investors. They're probably going to make them keep that. Now, I don't know that. That was part of the executive order that Trump wrote yesterday. They're looking at that. Maybe that'll be the starting point of their strategic reserve. But if Congress forces the Fed over the course of, let's say, 5 years to dollar cost average and acquiring more Bitcoin, and that actually happens, and it happens because, like as I mentioned, the other half of the market is now piling into it. Banks can invest in it. They can hold it. They can recommend it for clients. That would allow pension funds, sovereign nations to also do the same thing. Investors around the world will probably want to have some exposure to it just so they can transact in this uh, new way. And if that actually happens, then you can look at this 36, $37 trillion debt, and it could almost be offset completely, or at least in a large way, by that stockpile, this new cryptocurrency that we're looking at here. Now, I'm not saying any of this is going to happen this year, this administration's term. I don't know. But I am saying that there is a lot of opportunity, there is a lot of upside, and I can certainly see the utility and value of this new asset class in a way that I couldn't see before, even though we've entered this uh, asset class about a year ago, not just for me personally, but also for our customers. And it's worked out tremendously. And I can certainly see how it will. But you certainly cannot say that this type of move in crypto, even if it gets to anywhere close to where, you know, some of the numbers that we've just shared with the audience here, even if that were to happen, it could take a long time for that to happen. So, um, the market is a great place to build wealth. It's a terrible place to get rich quick. So, I do not want individual investors, clients, those watching this program to think of this as some sort of recommendation. This is a very volatile asset class. You truly need to understand this, and your position weighting is going to be extremely important, not just for, you know, crypto investing, but for any investing that you're doing. The weighting that you have in individual positions and sectors is a major driver of risk and reward. So, not a recommendation. I'm not trying to get everybody fired up or bowled up on this particular asset class. I'm just simply trying to help you understand why some of the folks in the administration want to take a look at this and see how we might be able to benefit from it as a country. And for taxpayers, I mean, damn, if we can, you know, eliminate a huge chunk of this, let alone all of it, why wouldn't we want to try it? What might that actually open up for U.S. citizens and businesses here in this country if we're not, burdening this amount of debt. Where basically 6.5% of our domestic production is going towards interest payments on our debt.
Mm.
And right now, as we're sitting here, the best that we can hope for is that number doesn't increase. So let's hope that these policies, this administration, whether you like them, love them, hate them, still trying to figure them out, let's have a little grace and support. We are all Americans. I want nothing but the best for all Americans in this country. This is the greatest country on the planet, in my opinion, and I'm certainly blessed to be a part of it. But I also see the concerns that are out there, and I'm thankful that we're at least open minded enough to try to take a look at some new things in a different way to see if we can actually benefit this country, solve some of the big problems that we have, and ultimately make this a more fun place, more exciting place for businesses and individuals to want to live and work in. So I'm very excited. I can't be more happy to start this new year. A lot to look forward to and a lot to be thankful for. But we also have a lot to address. And I'm looking forward to seeing how this all plays out. You'll hear it right from us about every 2 weeks in this show, the Shepherd Wealth Management Podcast. We certainly appreciate everybody watching. We certainly appreciate all of our clients and the support that we have from everybody. And look forward to sharing our thoughts, our opinions, and facts, as well as historical data throughout the coming weeks, months, and years. And with that, we'll part ways until next time.